First things first, let me start this video by wishing you a very happy new year. Now 2023 was a dream year for investors. The Nifty 50, Nifty Midcap 150 and Nifty Small Cap 250 clocked gains of 19%, 42% and 48% respectively. But will this momentum continue in 2024? In other words, will 2024 be yet another happy year for investors? Well, nobody knows. It's not possible to predict that. However, data can give you some clues on where things are headed. So we looked at a lot of data and chose 6 trends that can give you some hints on what to expect in 2024. These investing trends can make a significant difference to your returns in 2024, so do watch this video until the end. Hello and welcome to ET Money's YouTube channel. Before I start, an important reminder. The tax saving season is going on and you can get all tax saving options, ELSS funds, NPS, life insurance and health insurance on the ET Money app and invest in them without any paperwork. Plus you get instant tax proof as well. I've also mentioned the link to our video on tax saving in FY24 in the description. This video will help you not just save tax but also pick the right tax saving products. Okay, let's start with the investing trends now. Why worry about the economy in an investment related video, you might wonder? Well, that's because economic growth has a direct correlation to the rise in the stock market. If the economy does well, so does the markets. So we looked at 3 mainstream economic indicators: GDP growth, GST collections and crude oil prices. First, let's talk about the GDP growth. Now the latest GDP growth numbers released by the NSO revealed that the Indian economy grew by 7.6% in the second quarter of this financial year. This number is sharply above the RBI's estimate of 6.5% and has made India the fastest growing major economy in the world. So 7.6% was a positive surprise for the markets. The chief economic advisor said that while they are maintaining the FY24 GDP growth forecast of 6.5%, they may be underestimating India's GDP growth. That's music to investors' ears. Next comes GST collections. Now in terms of year-on-year change, GST collection have remained robust throughout 2023 with growth ranging from 10 to 24%. Now high GST collection signal a flourishing economy which bodes well for the stock market. Finally, let's see where crude oil is headed. High crude oil prices are negative for the Indian economy as they tend to balloon the fiscal deficit and cause a spike in inflation. Now fortunately they have trended downwards after peaking out in September 2023. That's despite the Israel-Hamas war. So crude oil doesn't seem to be a worry since it's below the levels it was at the start of the year. So all in all, India's economic picture looks robust. That should act as a tailwind for the markets. Now on the political front, it's widely believed that the current government will likely stay in power after elections this year. This predictability on the political front means policy continuity, which the markets like. Now that's one of the reasons that the market has been making newer highs. So all in all, it seems to be good on the economic front. Now let's talk about the next trend. Worldwide interest rates started going up in 2022 due to the inflationary pressures created by COVID-19 stimuli. In India, the RBI also raised interest rates to tame inflation. But there were no interest rate rises in 2023 and the repo rate stayed at 6.5%. Now, if inflation eases in 2024, rate cuts are likely and the signs of easing are already visible. The CPI has fallen after peaking out at 7.44% in August 2023. However, it has been a roller coaster ride and is still beyond the RBI's target of 4%. But investors can take heart from the US Fed's forecast of 3 prospective rate cuts in 2024 that could set the stage for rate cuts by other central banks including the RBI. So if the RBI does cut rates in 2024, that can fuel stock market growth as low interest rates reduce borrowing costs for business, leading to more profits. Also, lower rates in the US will mean more foreign flows into emerging markets like India. And that's not all. There's another dimension to a fall in rates. Long-term debt funds stand to gain when the rates fall. That's because the prices of the bond they hold go up, which are reflected in the higher NAVs. Now the recovery in the returns of long-term debt funds is already visible. After tepid returns in 2021 and 2022, long-term debt funds have done well in 2023. So a fall in interest rates in 2024 should further boost their returns. Alright, now let's move to the next trend. A popular stock market phenomena is buy the rumor, sell the news. This means that the stock markets tend to rise before a positive event and fall when the actual event happens as investors book profits. Now, can such event happen in 2024? A good barometer for this is the market's historic valuation vis-a-vis the current levels. The chart on your screen shows the Nifty 50's PE movement vis-a-vis the median PE. Now, PE stands for price to earnings and it's a popular valuation indicator. The higher this number, the more expensive the market is. But it's better to see the PE in relation to its historical means. Now, the Nifty 50's median PE over the last 10 years is 23.43 and its current PE is 22.81. So it is just around the median and therefore markets look fairly valued in historical terms. So the good news is the market is not overheated, but the bad news is it is not at a discount either. So it would be advisable to tread with caution. A correction can't be ruled out. Now, data shows that historically markets tend to fall 10 to 20% intra-year from their peak. But in spite of these intra-year declines, the full year returns are positive 75% of the time. So you must see corrections as an opportunities and continue to invest. Let's talk about the next trend now. Okay, so if the markets were to continue their move up in 2024, which sectors, stocks or funds would be at the forefront? Honestly, that's something only time can tell. But a good starting point would be to look at what didn't work well in 2023. Among the 50 Nifty stocks, Adani Enterprises lost 26%. MNC, banking and finance and large cap funds did well, but not as well as other categories. Oil and gas, services and banking sectors also failed to excite investors. So you can keep these stocks, fund categories and sectors on your radar. But it doesn't mean that you can rule out the toppers of 2023. They could well be driven ahead by momentum. For instance, Tata Motors delivered 100% returns in the Nifty 50 group of stocks. Infra funds delivered 44%. The defense sector zoomed 84%. You can pause the video and look deeply at these two lists, but do your due diligence to identify which may work in 2024. Now, any discussion on the leaders would be incomplete without talking about PSUs. PSUs continue to hog the limelight in 2023. As of December 22nd, 2023, the Nifty PSE and PSU bank indices registered returns of 78.7% and 35.9% respectively, against the Nifty 50's 19%. Now, will they continue to do well in 2024? Let's take a look at the historic valuation of these two indices to try to find the answer. We will look at the P metric for the Nifty PSE index. The Nifty PSE index has a median 10-year P of 10.4. It currently stands at 9.04. A good 13% discount. So if you go by historical data, it looks like the PSU rally may still have legs. For the Nifty PSU Bank Index, we will check the PB. PB stands for price to book ratio and it is a popular metric for banks and financial companies. Like the PE, the higher the PB, the more expensive the index is. But here also we will compare the current PB with the historical median. The Nifty PSU Bank's median 10-year PB is 0.9 and the current PB is 1.28. That's a premium of 35%. So it won't be wrong to say that it's in overheated territory. But there is a caveat here. All this is aggregate data. There could be very well individual outliers. So don't forget to do your own due diligence before taking a call. This brings us to the next trend. Will mid and small caps continue their upward march? Mid and small caps were on fire in 2023. The Nifty Midcap 150 index delivered gains of 42.4% and the Nifty Small Cap 250 index rose 48.1%. Now the natural question that arises is this: have mid and small caps become too overvalued? We checked the historic PEs of these two indices to find the answer. Now Nifty Midcap 150's median 5-year PE stands at 43.69 and its current PE is around this level at 43.3. This suggests the index is at fair valuation in historical terms. So further gains may be hard to come unless the earnings catch up. But what about the small caps? Well, we have about 3 years of data for the Nifty Small Cap 250 index. Now the median 3-year PE of this index is 35.28 and its current value is 39.73. So it appears to be overvalued. Given the steep run up in both mid and small caps, it will be a good idea to be cautious. We have prepared a video on investing lessons from 2023. To get the most out of this video, I would recommend that you watch that video also. Let's now talk about the sixth and the last trend. We should not overlook the challenges that lie ahead. The Russia-Ukraine war isn't over yet. Israel is getting more aggressive towards Hamas. China is getting more assertive about its Taiwan stance. And who can forget the AI threat? Added to these are the ever-present threats of black swans. By their very definition, black swans can't be predicted. So what should you do if you are concerned that the markets may be ripe for a steep corrections and are just waiting for an excuse? Well, stick to your asset allocation and rebalance your portfolio periodically. This will ensure that you book profits, invest in the undervalued asset class, and reduce your portfolio's volatility. You can watch our video on investing lessons from 2023 for more insights into this. Now, another way to safeguard your portfolio is to explore balanced advantage and multi-asset allocation funds. Balanced advantage funds adjust their portfolio dynamically based on market conditions, while multi-asset funds spread the corpus across asset classes to reduce risk. In all the calendar quarters since 2018, when the Nifty 50 delivered negative returns, balanced advantage fund and multi-asset allocation funds did better. So they have a solid track record of arresting negative surprises, and they also contribute meaningfully when the markets rise. They have even done better than the Nifty 50 at times despite their data allocations. And with this, we have come to the end of this video. I hope you found this video useful, and if you did, do share it with your friends and family. I'll see you soon with another insightful video. Till then, take care.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.